Hey everyone, welcome to the show. This is Dave Keller here at StockCharts.com. Today on the final bar, we're going to wrap the week. It's my favorite part of Friday's activity. Try to make sense of where we've come from now that we've locked in the weekly close. How has this week's action affected the long-term trends? Now the S&P settling into that range between 2,800 and then 2,950 at the top. Nice sort of holding steady today on Friday. So we'll take a step back and see where we're headed next. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to today's show. This is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close for the final bar to take a look at today's price action through the technical lens, try to make sense of the movements of the day, and connect the short-term action of today's session with the long-term trends. And when we talk about a long-term trend in equities, I think we had a long-term downtrend, a long-term uptrend, that bear market rally, and now we are decidedly sideways. I feel like today's action, while finishing in the positive for the S&P, still sort of chopping around and showing you really further establishing that range between around 2,800 and 2,950. And I think as we look at how the week has evolved, we look at the wrap the week segment where we're looking at the Mindful Investor Live chart list. I think you'll see how some of those long-term measures overall starting to tilt negative, but remaining in a sideways formation. Should give us a sense of where things could be headed next. Now, we've had a lot of fantastic guests on this show and elsewhere on Stock Charts TV in recent weeks, and next week is going to be no different. On Monday, our next episode of Behind the Charts is featuring a conversation I had with Matt Lampert. Matt runs the Socionomics Institute, which is part of Elliott Wave International down in the Atlanta area. I had a really cool conversation with him about market sentiment, about market behavior, about social mood, and some of the guideposts you can look for from pop culture to get a sense of where things are headed. And what's fascinating is we cut that video in mid-February, turns out right before the market top, and some of his answers were actually incredibly prescient about some of the euphoric nature of things that we were seeing in mid-February. So a really cool interview to pay attention to this coming Monday. And then later in the week on the final bar of this show, we have Todd Campbell from EB Capital Markets on Tuesday, Doug Bush from Chart Smarter on Wednesday, and then from the New York area, Kim Sokoloff joining us on Thursday, May 21st. So some fantastic guests coming up next week. Let's move right into our market recap. So as I've talked about in the introduction, the day started low. We sort of traded low out of the open, came right back out to yesterday's close, and then most of the morning session was sent below those levels. And then in the afternoon, after lunch around 2 p.m. Eastern, we start to break above, finish toward the highs of the days, and that put the S&P 500 to around 2864. That's up just over 1/3% from Thursday's close. NASDAQ up a little higher with the NASDAQ 100 up 0.6, NASDAQ Composite up 0.8%. Above 9,000 it remains. Small caps, mid caps up a little further. So mid caps up 0.7%, small caps up 1.3%. So by the end of the day, small caps, mid caps actually finish in the positive. What's interesting is if you look at the small cap chart, all of these sort of gap down in the morning, sort of traded lower, but small caps actually were in the positive in the first hour of trading. Compare that to the S&P 500, sort of caught on later on. So sort of the small cap trade that led things up at the beginning of the day, which is sort of an interesting departure from what we've seen normally. Let's look at a chart of the S&P, and then we'll get back to some of the other charts. So again, here we're just going to talk about some of the short-term ramifications. In our Wrap the Week segment, we'll dig a little deeper into the longer-term themes. But when I talk about the range for the S&P 500, this is sort of what I'm settling in on. And this weekend, when I go through all these charts, I'll probably bump all these lines out a little bit because they're still very relevant. We've now had this, the down phase, February to March, the up phase, March to April, and now the sideways phase that we are now in from a tactical perspective. Now, we have had a segment of lower highs and lower lows. That's what we saw here with this week's high, lower than the previous high, this week's low, lower than the previous week's low. So overall, we're sort of pulling back a little bit. And that's why we're sort of in this range from 2950 on the upside. That's a level we've been talking about for a while. Just above there, you have 3,000, obviously pretty meaningful with the 200-day moving average. On the downside, you have around 2,800, and that's the level we traded below yesterday, but closed back above toward the highs of the day. And so that's the 50% retracement of the February to March sell-off, and also the ceiling there. So here's the directional question, right? Question one is this a bull flag pattern? And that's what happens when you have a big up run. You have this, sort of corrective pattern, lower highs, lower lows, sort of a move against a counter trend move, parallel trend to the downside. If we break above that level, so a break above 2950 becoming more and more important, because that would break out of that bull flag pattern, confirm that pattern. I think if you accelerate through the 200-day moving average, I think we're going back to previous highs, 3,400, if not even further. If, however, we fail at 2,800, if we do not validate that flag pattern and continue to break to new lows, continue this pattern of lower highs and lower lows, I think that's where we're going much further down, arguably 2,500, even 2,400. That's sort of the line in the sand I would have in mind, just based on nearing the previous lows, but not probably getting that get to that extreme. So a really interesting point this week has really confirmed that sideways trend, either a bull flag pattern, a corrective move, or a sideways pause before we continue this tactical downtrend. Now, what else happened today? We had comm services, number one, consumer discretionary, number two. Both of those two sectors outperformed the S&P at a pretty decent clip here, finishing up 1/3%, followed by materials, and gold stocks have been pretty consistently at the top. Newmont Mining's been one of the greater names in terms of the scooter rankings, and that certainly seemed to follow through. On the downside, you have utilities, which is really one of the more defensive parts of the equity universe. Real estate third from the bottom as well. Financial second from the bottom. And the XLF was one that was up pretty big yesterday. A nice bullish engulfing patterns across the board. We looked at Wells Fargo and some other stocks yesterday, just reflecting on that upswing. But overall, coming sort of right sizing today, coming back to being a market laggard, which is where financials have been, honestly, for quite a while. Tech, sort of a market performer, sort of right in the middle, sort of a yawner. To be honest with you, healthcare up a little bit more, but overall, those were sort of non-factors relative to some of these other, the barbells or the other extremes that you saw on the upside and the downside. In terms of stocks making pretty significant moves, interesting to see something like Kraft Heinz in there that's within staples. But again, sort of this short-term pullback phase, but the last couple of days sort of rallying very nicely, moving up toward the tops. Interesting to see a lot of consumer names in the top 10 list of scooter gainers. This is AAP, Advanced Auto Parts, within specialty retail. A number of these stocks have had this nice rally, and if you think about the S&P sort of correcting, pulling back a little bit, something like Advanced Auto Parts actually correcting, but still seeing higher highs and higher lows. So today, finishing toward the upper end of the range for the week. And again, you see a follow through next week. That's actually a pretty nice pause before a continued breakout for something like Advanced Auto Parts. So setting up potentially kind of nicely there. TJ Maxx actually rallying pretty nicely as well. This is TJX, the ticker. Now again, what concerns me about some of these apparel retailers are coming out of a pretty bad breakdown. So a lot of these names broke down earlier this week, breaking down a new closing low for this phase, which really meant to transition, I think, visually from an accumulation phase to a distribution phase, a clear pattern of lower highs and lower lows. Even though we rallied today to the 50-day, we're still making lower highs and lower lows if you look at the longer trend. And until that pattern changes, I think you have to be a little cautious about something like TJX rallying so significantly there. Also interesting to see a home builder there on the top 10 list, Lennar. So if you think about the S&P sort of having this parallel downside correction, you can see the home builders have actually held up a little bit better. They pulled back as most things did this week, but again, back in the middle of the range for the previous 2 weeks. You know, some of these home builders, especially Lennar, you see it's right below this 200-day moving average, which has been essentially flat now for a little while, because it had been pretty good above it, now below it, and now sort of settling into that middle range. So you really want to see it reclaim the 200-day, which would also put it above that swing high from last week. If that was able to happen, I think home builders could be setting up pretty nicely with the relative strength that's, to be honest, sort of been improving. So some interesting charts on the upside. Lots of charts making big losses. in their scooter reports. I think concerning anytime I see some semiconductors on this lower list. You see Applied Materials, KLAC. These are stocks that are sort of pulling back in their scooter rankings, showing some weakness going into the weekend. That's our market recap for today. Plenty of movements, plenty of themes to unpack, and we're going to go right into our next segment, which is Wrap of the Week. This is where we take a step back and look at some of the big picture thematic shifts over the last 5 trading days. We asked you recently on our StockCharts TV poll. We always have a poll running on StockCharts.com/TV. Check it out, and please make sure your vote is a great way to maintain a good dialogue between us, see what you're thinking, and incorporate that into some of our discussions. We asked you, what do you think you provide the best returns over the next 3 months? And we asked this over the last couple of days. 70% of you said large cap stocks, the S&P 500. 12% said the mid cap index. 16% said small caps, IWM. Only 2% of you said micro caps, the IWC. So interesting to see, 70%, over 2/3 of you said the S&P 500. When I'm asking that question about cap tier performance, I immediately start thinking about some of these charts, which are comparing the returns of these different cap tiers, large versus mid versus small versus micro caps. And so I'm going to look just year to date to show you how these things have evolved. And so where I think many of you are coming from, which is totally valid, is if you take year to date, and this, obviously there's been plenty of movements between there. You had the market peak in February, the market sell off into March, but look at how large caps really remained above everything else pretty consistently. That departure happened really right out of the gate. So in the first couple of weeks of trading, the large caps were the one out of the 4 that were still in the positive, while some of the others were pulling back a little bit. Made a higher high while most others made a lower high, which was one of the great divergences of, I think, that February peak. If you look at what's happened since then, everything's recovered. Mid caps have actually been the #1 performer out of the market lows, but year to date and since the February high, you still have large caps being the top gainer. Now, a lot of people have speculated that, and while the S&P has remained relatively stable, a bit of a lower peak, but not much, you can see that some of these other cap tiers, especially small caps here in green, have made a confirmed lower peak, so sort of already breaking down before large caps. While large caps sort of in this sideways trend, these other 3 certainly to me appear to be in more of an established downtrend, a tactical downtrend of lower peaks and lower values. So I see what you're saying, and that's not a bad call. I think if the market does pull back from here, I think you're in a good place to favor large caps over other parts. We're going to look a little later about relative performance of small caps. I'd want to see that improve before I would answer anything in the bottom half of that list of cap tiers. So thanks for answering the question. I think for the most part, I think you guys are in good shape in terms of where you're thinking of large cap performance. Certainly seems to have been consistent. Let's go to our Mindful Investor Live chart list. This is the way that we review things on a Friday to make sense of them. We're going to start with this market trend indicator. This is something I've used for a long time, a number of years, and it's based on long-term weekly averages. So this is the weekly 21-week and 34-week exponential moving averages here in the top with a weekly S&P chart. So my long-term view is basically looking at which one is above or below the other. So this turned negative sort of mid-March as the market was really selling off, and really near the bottom is when it finally turned negative because it was enough of a downtrend. It has remained negative based on what's happened since then, remains in a bearish posture. So the long-term signal by my read is still negative. That's why I still see this as a sort of a bear market rally. The medium-term signal came very, very close to registering a buy signal this week, but didn't quite do it. It's still sort of just narrowly favoring the bearish point of view. And so overall, the medium term, which is based on the weekly PPO, based on the traditional settings, the 12 and 26 and 9 bars. So that's, or periods. And so that's remaining in a negative signal. The short-term signal is the difference between those two. And that's sort of how I read my model. So this increase that you've seen, this narrowing of the moving averages that turned in late March has remained positive. So, my read still remains short-term. The tactical read is positive. Medium-term, long-term still bearish, and very, very close to registering a buy signal on the medium-term. That feels about right to me based on what I've seen and nearing those significant resistance levels. This is the resistance that we looked at earlier 2950 to 2800. I think that's a key range. And one of two things is going to happen. We won't remain in this range forever. Either we break to new highs and break above the 200-day. I think in that case, you need to, feel bullish bias, long and strong, up and to the right, aiming to 3,400, to be honest. Or we break down through these support levels. We validate this, the meaningfulness of this resistance, and we're heading down to the 2,400, 2,500 range. In terms of breadth, this is something we looked at earlier in the week. I think one thing that concerns me about the overall longer-term strength of equities is this breakdown in the cumulative advanced decline lines. They've all established a pretty clear lower peak and now have gone to a lower low, and that's unique. That's the first time that's happened since the market bottom on March 23rd. So that tactical read now is turning a little more negative. I think that's where the breadth has been a little more concerning. If you look at the new highs and new lows, it's a little zoomed out, but if you look, you're just starting to get very few new highs in the equity space. But if you look at the S&P and the New York Stock Exchange, you're starting to get more and more, especially this week, more and more stocks making new 52-week lows. We haven't seen that in quite a while, actually. This is the most we've seen since the first week in April. It was that first pullback after the V bottom, that major bottom in March. So starting to see some new lows, more and more of those in the coming week or so. And I think that suggests that we're getting the rollover that I think many expect. By the end of the week here, you've had a lot of stocks sort of toying with their 50-day moving average. The S&P 500 remains above it, but if you look now, just over 50% of S&P stocks above their 50-day. So it's right about half and half. Only 26% of the S&P names above their 200-day. So just like the S&P remains below its 200-day moving average, most stocks still in that configuration. Again, I think that to me sort of confirms that medium-term bearish sentiment. You get that breaking above 50, over half of S&P stocks getting back above their 200-day. I think you can be a little more optimistic about long-term prospects for the equities. In terms of sentiment, the one I tend to look at is the AAII rankings. Just in general, you've had this trend of less and less bullishness coming out of these market lows, and so 23% of respondents bullish, 50% still negative on stocks here. Just a couple more ratio charts to finish out our read here. One of the ratios we love to look at is the ratio of consumer discretionary to staples. That is has sort of stabilized but continues positive on a cap-weighted basis. On an equal-weighted basis, though, has been turning lower, and that's been for the last couple of weeks. I think we've continued this pattern. So, you take Amazon out of the picture, and overall, you sort of have favoring staples over the last couple of weeks. You actually saw a number of staples on the scooter gainers list today, which is sort of interesting. And the last one I wanted to point it out was just the relative performance of semiconductors. Semiconductors really over the last 2 months, last month and a half, since that first move out of the March lows, have been sideways. They've been sort of a market performer. I would love to see this break out to new highs to confirm further upside for stocks, and we've not seen that yet. On the other hand, if you start to see this breaking down to new swing lows, which we have not seen yet, if you start to see things roll over a little bit there for the SMH, the semiconductors ETF, that tends to be a good leading indicator for stocks. I think that might validate more of a bearish thesis in the coming weeks. That's our wrap the week segment. Again, so many charts to go through. I try to hit on some of the key ones that have jumped off the page during my normal weekly review. We're going to take a quick commercial break. Back opening the final bar mailbag and answering your questions. We'll see you in a minute. Hey there, welcome back to the show. This is Dave Keller at StockCharts.com. We're going to open the final bar mailbag in just a moment. I wanted to remind you, we love hearing from you, answering your questions, and especially giving us feedback. We've been running the show for a while now. We started this last fall, but are always looking to tweak the process, improve things. So any questions, any feedback, get them to us via email, thefinalbar@StockCharts.com. We'd love to hear from you. Now let's open the final bar mailbag, get to a couple questions from you over the last couple of days. Question one, a question on relative strength. I talk about relative strength often, so I appreciate this question on different time frames. I'm trading the intermediate time frame using daily charts. I see the relative strength making highs and on the long term, it's making lower highs and lower lows. So what happens when the relative strength disagrees from one time frame to another? The example you used is with the GLD. So I'll try to recreate the question you had. So this is on the daily chart. You can see that the relative strength improving gold, making actually a new price high. Relative strength still sort of coming up here, and I'll switch very quickly to sort of a weekly view to see the relative strength. Oh, wrong chart. There we go, weekly view. So here, yeah, right. I get what you're saying. So what happens when on one time frame the relative strength is improving, on another time frame it's not? So I think what you have to remember is it all is about your investment horizon. So when you're looking at something like relative strength and you're starting on the daily chart, what you want to do is think about the period you're looking out for, and then think about what that chart is telling you. So for me, if I'm trying to look a couple months down the road, like 3 months or so, 3 to 6 months, the daily chart makes sense. So you can see I'm looking at a 2-year chart, and I think I can make a good sense of the next couple months using that time frame. But if I'm trying to look out for a year or two, this isn't nearly enough data to consume. So I need to look at a weekly chart, bring in 5, 10 years of data. So you think about it, the look forward amount, whatever horizon you're looking out to, you want to back that up by like 6 to 8 times going back the other way. So that's as much history as you want to look at to be able to make a proper assessment on there. So when I'm talking about gold and I'm talking about relative strength improving, when I'm using the daily chart, then I am doing a lookout period based on what I think a daily chart makes sense for. So for here, I'm usually probably talking about the next 1 to 3 months is what makes sense. And when there's a breakdown, I think that tells you about the next 1 to 3 months on average. That's sort of my back of the envelope thinking for that. And then if I want to look 6 to 12 months even further down the road, this isn't enough data really to make that assessment from a technical perspective. So you really want to be looking at weekly, if not monthly charts to sort of do that. So your question was what time frame matters the most? And I guess the answer going back to you is it depends on what time frame you are trying to win the game. So for me, I'm usually finding as a technical analyst, I'm answering that question about what the next 1 to 3 months hold. And so that's where I'm, that's the daily chart that I'm usually using. Great question. Question number 2, stock charts and volume. As you know, there's aftermarket and pre-market trading, after hours and pre-market trading. Absolutely right. A lot of times the volume's light during those periods, but with earnings surprises, there can be a big spike. Is volume added to the volume that we're looking at? Oh, on the stock charts volume. So you have that volume distribution that pops up here. Is volume included? So no, in general, when you're looking at prices on stock charts, we are using sort of the pit session. We're using 9:30 a.m. to 4 o'clock p.m. and whatever other final ticks tend to come in right after the close, the official closing price in some markets. That's the window we're looking at. We are in the process of adding after hours trading, pre-market trading. Where you will see that now is on the simple summary page. That's where we've just started to add some of that. So if you click on here, go to symbol summary and enter the ticker, you'll start to see after hours trading. So around earnings, that's going to be the place to check that out. We have not incorporated that into our charts just yet. We're sort of figuring out, because I'll be honest with you, it opens a whole can of worms on how you're going to incorporate it. So indicators at this point don't include after hours trading. It's just normal trading hours. And again, to be honest with you, there tend to be big price movements, but relatively lighter volume compared to what you're seeing during the regular trading session. So right now we're sort of considering after hours trading, pre-market trading an indication of where things are at. So you'll see it on the simple summary page. At some point, I wouldn't be surprised if we start giving you options to incorporate it into the price bars in some way. And we'll be in touch with you when we're ready to do that. So no, volume not including after hours trading at this point. On Wednesday's show, I used the ACWI. Oh yeah, all right. I saw this question about the ACWI. It was actually on this chart list probably. You said, what the heck with your denominator is where I would summarize your question, which is very well thought out. Here I'm doing the ratio I tend to do to look at the US versus the world is the SPY, the spiders, versus ACWI, all country world index. And you correctly are pointing out that my numerator and denominator include the same thing. And you're absolutely right. I'm saying the US versus the world, and I'm actually saying the US versus the entire world, which includes the US. About half, maybe over half of the cap of the all country world index includes the S&P 500, includes US stocks, right? So why would I do that? You could look at it either ways, and you sent me this great chart showing you the difference between them. You're absolutely right. In here, the black line, the blue line, it looks like, is the S&P essentially versus ACWX, which is sort of all country world ex-US. It does not include the US. And I'm doing the orange ratio, which is the US versus everything. To be honest with you, I have not found that there's a big enough difference between those two. I don't use it as a timing signal. I'm more using it as an overall illustration of where investors are leaning to US or outside the US. And if you look at the movements of these two, they're pretty homogenous. There are some divergences you point out, but I think it's totally fair. So, if I was using this as some sort of system, I probably would dig deeper into which one of them made more sense. But for me, I think, to be honest, either one of them makes a ton of sense. And I've used both in different environments. The SPX or the VTI over the ACWX would give you a pure US versus non-US, and that might be a great way to illustrate it. Fair question, totally fair conclusion. The last one to finish up our mailbag: if the stock market is going to correct and become a triangle, are you able to predict where the bottom of the triangle will be? I'm assuming we are not going to go all the way back down to the old low. I'm assuming what you mean is this huge triangle here, which I don't know if I would actually call that a triangle. I think, to be honest with you, if you read like John Murphy, Martin Pring, some of those classic texts, or even Charlie Kirkpatrick and Julie Dahlquist wrote the book that the CMT Association used for years as the textbook for the CMT program. And when I taught at the top college level and taught technical analysis, I used the Charlie Kirkpatrick, Julie Dahlquist book. All of them have a similar sort of thing when you're talking about price patterns. To be honest with you, this is not an idealized triangle pattern because this range from February high to March low is so different than that range there. So I don't think you can say that's a big top to the triangle and we're maybe making a lower one. I think things would have to evolve much further than that before that would even look anywhere near that. In general, a triangle is more of a shallower, it's not a sharp sort of correction. It's more of a shallower consolidation where you see a clear pattern of lower peaks, a clear pattern of higher valleys, and it really forms this coiling pattern. This is less of a coil because I think this is an order of magnitude different from February to March to April to May. That it's very subjective. I think that's where a lot of people criticize price patterns because they're very visual and we see visually many more patterns than are probably valid. But again, I think in general, you want to think about an idealized triangle pattern. If you look back to textbooks on the symmetrical triangle, look at our chart school article, you'll see this is not really a textbook triangle pattern, I think, based on what you're asking. Thanks so much for those 4 fantastic questions. Those are really well thought out. Many of you included visuals that were really helpful to understand what you were asking. So keep them coming, folks. Happy to answer any questions I can. We are going to wrap this show and wrap the week on the final bar by doing the 3 and 3 charts, 3 minutes. Here we go. 1 minute, I'm told in my ear sternly by my producer. So let's go. Chart number 1, the S&P market trend. So here I'm looking, we mentioned this earlier, looking at the weekly data using exponential moving averages as just a systematic way. And again, I don't bet anything based on the system. I would not say I am purely bullish or bearish based on the system, but I have found that having a systematic, a rules-based thing running in the background helps keep me honest and helps me question what I'm seeing, what I'm hearing, because this is, given a vacuum, given all else being equal, this is where I should probably lean. And this is telling me the short term remains tactically positive, the medium term remains negative, the long term remains bearish as well. And I think that's where we're at. Chart number 2 is looking at new highs, new lows. I've zoomed in just the last year so you can see, again, it's very early, but you can see we're starting to see an increasing number of new lows. Now, again, it's 82 out of thousands of stocks on the New York Stock Exchange. So I'm not saying it's a huge capitulation by any means, but it is worth noting that as this week has gone on, you were seeing, relatively 0 new highs and an increasing number of new lows. If that trend continues into next week, I think we could start to be a little more concerned that the S&P is holding up because of people flocking to that mega cap, large cap safety trade, and the smaller cap names, the more speculative names, the breadth continuing to weaken. The final chart is looking at the relative strength of the small cap index. This little breakout a couple of weeks ago started to get me a little excited, thinking, wow, maybe this is the return of small caps. Today they led higher, but if you look at the ratio overall, it's still fairly negative. We've not seen a breakout of sorts. And again, I still think, 70% of you said large caps are the place to be. I don't think you're necessarily far off there. I think that's a decent place to be focused. Ladies and gentlemen, that's our show, and that's a week for the final bar. Thanks for joining us every weekday after the close. Keep your questions coming to us, the final bar at StockCharts.com. And hey, check out our YouTube channel. A lot of good replays on there. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you next week.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.